Have you ever wondered what these financial terms mean? Welcome to the world of finance, where terms like amortization, annuity, arbitrage, and many others often leave us scratching our heads. But worry not. Today we're embarking on an enlightening journey to understand these terms, their significance, and the role they play in our financial lives. From asset allocation to hedge, we'll unravel these complex terminologies one by one. So fasten your seatbelts, stay tuned as we decipher these financial jargon in simple layman's terms. First up, we have amortization, and finishing with blue-chip stocks. Let's dive in. Amortization, in the simplest terms, is the gradual paying off of a debt over a fixed period of time. Think of it as a mortgage on a house. Next, we have annuity, which is a series of payments at fixed intervals, typically made over a specified period. It's like receiving a paycheck every month. Arbitrage, on the other hand, is the simultaneous buying and selling of securities, currency, or commodities in different markets to take advantage of differing prices. Then comes asset allocation. It's how an investor distributes their investments among different asset classes like stocks, bonds, and cash. The balance sheet is a financial statement that shows a company's assets, liabilities, and shareholders' equity at a specific point in time. Bankruptcy, as many of us know, is a legal process involving a person or business that's unable to repay their outstanding debts. Lastly, blue-chip stocks are shares in large, well-established companies with a history of reliable performance. It's the heavyweights of the stock market world. Now that we have understood these terms, let's move on to the next set of terms. Continuing from where we left, we now move on to book value and ending with corporate bonds. Imagine you're at a yard sale and you pick up a dusty old book. The price on the tag is its book value, the value of a company's assets minus its liabilities, as recorded in its financial statements. Next up, we have capital expenditure. Think of it as the money you'd spend on a new fridge or a car, big-ticket purchases that provide value over a long period. In business terms, it's the money spent on acquiring or maintaining fixed assets like buildings or equipment. Cash flow is as simple as it sounds. It's the money that is moving in and out of your wallet, or in this case, a business. When you borrow money, you might have to provide collateral, something of value that the lender can take if you fail to repay the loan. Lastly, a corporate bond is like an IOU issued by a corporation. In return for your loan, they promise to pay you back with interest. Great, we are halfway through. Let's proceed to the next set of terms. Next up, we have credit risk, finishing with dividend yield. Credit risk is the possibility that a borrower will fail to repay a loan. It's like lending a book to a friend who's notorious for never returning them. You're taking a risk that you might not get your book back. Moving on, the debt-to-equity ratio is a measure of financial leverage, illustrating how a company's capital is structured. Imagine having a cake made of two layers, debt and equity. The ratio tells you how thick each layer is in relation to the other. Default is simply when a borrower doesn't meet their legal obligations, like missing a mortgage payment. It's like skipping out on dinner when it's your turn to pay. A derivative is a financial contract with a value that's based on an underlying asset, such as stocks or commodities. Think of it as a bet on future price movements. Finally, dividend yield shows how much a company pays out in dividends each year relative to its share price. It's like the interest rate on your savings account, but for stocks. On to the final set of terms. Finally, we have earnings per share, EPS, and ending with hedge. Let's start with earnings per share, or EPS. This is a company's profit divided by the number of common shares it has outstanding. It's like slicing a pie, the pie being the company's profit, and the slices being the shares. Next, we have equity, which is essentially the value of an ownership interest in a business, like stocks, for example. Then there's the exchange rate, which determines how much one country's currency is worth in terms of another's. Financial leverage is like using a lever to lift a heavy object. It's a way businesses can use borrowed money to potentially increase their profits. The gross domestic product, or GDP, is the total value of all goods and services produced by a country in a given period. Finally, a hedge is a way to protect against potential financial loss. It's like insurance for investments. Congratulations, you have now a better understanding of these financial terms. Well, that's a wrap. We've journeyed from understanding amortization to exploring the intricacies of hedge. Each term we've covered, from the complexities of debt-to-equity ratio to the simplicity of blue-chip stocks, plays a vital role in the financial world. Understanding these terms is not just about learning new vocabulary, it's about gaining the knowledge to navigate the financial landscape with confidence. So let's keep these terms at our fingertips. Remember, Knowledge is power. Until next time, stay financially savvy, keep learning,